Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. So today, I want to talk about 5 clever ways that the IRS builds a criminal case against you. And the reason we're here, y'all know when I do topics, sometimes there really is a reason behind it. And a lot of times what I get from people is how can I get caught, right? People come to me and say, okay, I don't want to report this income. All right. Can I tell you that is the worst thing that you can say to a tax person or a CPA? Okay. Our job is not to help you illegally hide cash from the IRS, hide your money. Our job is to tell you how to legally reduce your tax liability. That's our job, okay? So basically, don't come to me with the criminal stuff, all right? But I want to share with you how these things happen and then, and really help you understand how this stuff works, okay? So, all right, so number 1. The Bank Secrecy Act. Now, the Congress passed the Bank Secrecy Act in 1970, and these were the first laws to help fight money laundering in the United States. And this requires businesses to keep records and files. This is coming right from the IRS. Records and file reports that are determined to have a high degree of usefulness in criminal, tax, and regulatory matters. Okay, so with the Bank Secrecy Act, the main thing that people hear about, or they may or may not know about, is the $10,000 benchmark, okay? So if you are a business that receives $10,000 in cash, okay, then you are then you are required to report that to the IRS. So if I have a $10,000 program and somebody drops $10,000 at my house, I need to fill out a form that reports that to the IRS. And this is also the same with banks. If you go to a bank and you drop $10,000 to deposit, then they got to tell the IRS. If you withdraw $10,000 in cash or more, they got to tell the IRS, okay? And so to try to avoid this reporting, some people do what's called structuring, okay? And the most recent case is the little boy from Jersey Shore, Mike, what do they call him, the situation or something, where he got himself in a situation, okay? Because he was convicted of one of the things he was convicted of was structuring. Structuring is when you structure your bank transactions in a way that avoids the reporting requirement. All right. So you might deposit deposit $9,000 here, $8,500 over there, having all of these deposits trying to keep from being reported to the IRS. Okay, that does not work. All right. And it's illegal. But in addition to the bank part, structuring also applies to your third party payers. So for instance, I had a consult with an e-commerce person that says, okay, well, when I get close to like $15,000 in this account, then I switch to that account. Like, okay, that is structuring, because what you're trying to do is to stay under the reporting requirements for PayPal and, and Stripe or whatever. That is also illegal. So you can try to hide from the IRS, but that's only going to work for so long. Okay. So that is what structuring is. It is illegal. You are intentionally trying to avoid the Bank Secrecy Act reporting, and you can go to jail. All right. That's number 1. Number 2 is civil exams, also known as audits. All right. Audits are not criminal investigations, but they can lead to criminal investigation. So it can start out with something so simple as a mail audit, where you get a letter from the IRS and they're saying, hey, we want more information on this, or we want to see this or that and the third, right? That is a mail audit. But when you don't comply with the mail audit, it can trigger a field audit. Or if you did something so heinous, we just come into your house. That is what a field audit is. When the IRS comes to your home or your place of business and they want to see all your records, They want to see everything. That is the field audit. That's the thing that y'all see in the movies that you're like, oh my gosh, the IRS does that. Okay, yes, they do. They absolutely do. And that is like the worst end of an audit. There's a couple of other steps before that. But anyway, during that field audit, if they find something that doesn't look quite right, then they calling their partners and said, hey, FBI, we need y'all to come on over here because you might have a little something, something, right? So an audit can turn into a criminal investigation. Okay. One of the things like dealing in cash, I think the most recent one was DMX. Okay. That whole dealing in cash thing. I'm going to talk a little bit more about that at the end because I want you to understand how you get caught dealing in cash. Okay. Okay. So that was number 2, civil exams. Number 3, collections cases with the IRS. Okay. The last thing you want to do when you strike a deal with the IRS, whether it's through a payment plan or if you come to a settlement agreement with the IRS, the last thing you want to do is lie about your income. Okay. There is a case where there was an employee who had some tax debt. He got an attorney. They set up a plan with the IRS. Okay, great. Everything's fine. But then that same employee turned around and started falsifying his W-2s, underreporting his income. All right. And so then the IRS examiner noticed that this significant drop in income. So then the IRS called the employer to get the original W-2. And so that person then became liable for fraud because see, when you, and then if you have an agreement with the IRS and then you break that agreement either by not paying as promised or you lie like that, then they have the right to demand the full amount that you originally owed, and they have the right to demand it right now, right? So this is what you have to understand, that, lying to the IRS, falsifying documents and everything, when you have already established this agreement, also dealing in cash so that you can try to avoid reporting that income to the IRS so you're not paying them what you owe. That's criminal. Okay. You can go to jail for that. All right. Number 4, whistleblowers. Oh my gosh. This is one of the, okay, so for lack of a better term, like the best things ever. Okay. But the IRS has what's called a whistleblower program. Yes, it is a program. This is where basically somebody rats you out for money. Okay. So the whistleblower can receive 15 to 30% of what gets collected. These are also known as confidential sources. And like a lot of people 15 to 30%. Well, let's talk about who can be whistleblowers. Okay. So, innocent spouses. Okay. No, okay, hell hath no fury, right? So usually like in a divorce proceeding, if you've got a spouse that finds out that you've been hiding money and stuff, and instead of coming to you and y'all working that out, they decide to go and tell the IRS, that is a whistleblower, okay? Or even ex-employees, right? So there is this case in, I think it was New Jersey, of this pizza parlor, right? Hold on. So this pizza parlor, they fired this guy. They fired an employee. The employee was ticked. So he called the police saying, hey, this pizza joint is a front for a drug ring, right? Which that was not true. It was not a drug ring, but they got a tax person involved and they figured out that the pizza joint was underreporting their income. Okay, so it went from being an issue of being a drug ring to you're committing tax evasion by underreporting your income. So there was someone who sat outside and counted the number of pizzas that left the pizza joint. And they figured out based on that the pizza parlor was underreporting their income. And I think they wound up getting shut down. That was one of the craziest cases I have ever heard. It was just hilarious. Okay. But people think like whistleblowing, like 15 to 30% is not a lot of money. But let me tell you about 2 recent cases, the ones that I know about. All right. So number 1 was in June of 2017, where there was a case against Caterpillar. All right. The whistleblower stands to gain $600 million. That's a 600, a comma, and 6 zeros. $600 million. And then there was a case back in 2012 against the Swiss bank UBS that whistleblower stands to gain $104 million. So depending on who you blow the whistle on, this could be a very lucrative thing. I mean, people do make money with this whistleblower thing. That's why it is a program. Okay. Like for real. Like people don't understand that. And the last one is my favorite: social media posts. Holy cow. Listen to me. The IRS uses social media just like you do. They go through, they look at your social media posts. They look at what you're saying. They look at Facebook, Twitter, whatever, right? Because see, as marketers, we show this lifestyle, right? We go to these events. We at the all white party. We on the beach. We're showing all of this lifestyle, right? But, but you're not showing any work though. And so the IRS comes back and says, okay, I see you on the beach. I see you at the party, but I don't see you doing any work. That was not a business trip. That was a personal vacay. Okay. Right? But also you think about too, when you see these social media posts of people flashing cash, we out, taking all of our friends out to eat. We're posting bogus tax information. Okay. You got people that are giving bad tax advice based on what they're doing, what they're deducting. Okay. So you're telling on yourself in these social media posts. All right. And so when you're being investigated, the IRS is building a case. They're putting all of this stuff together. And they're saying, okay, so how is it that you got a new house? You got a new car that your post says you paid for it in cash, right? You got all of this stuff, but we don't have no tax money. Okay. And so that's how they build a case against you. So, so you like, how does this happen when you're dealing in cash, because cash is untraceable? Well, the IRS looks at your credit report. If you suddenly have this drop in income, but they look at your credit report and ain't none of your credit card bills late, you haven't been evicted from anywhere, you haven't had a house foreclosed on, you had missed an electric bill or anything like that. So then the IRS says, okay, well, if you're only reporting $20,000 a year, you live in a 6-bedroom house still, but you haven't missed any payments or something's not right. Okay. They start to build the picture. So then they go and look, okay, so you bought this brand new, I don't care if it's a Nissan, right? I don't care if it's a Nissan. You paid, $25,000 for this Nissan, and we see $25,000 cash. How can you pay $25,000 cash for a Nissan and only making $20,000 a year? That don't add up, right? So they look at the type of lifestyle if you're leading, because see, if you, at one point you're reporting this 6-figure income and then suddenly you're down to, 5 figures, you're like $50,000, then you expect to see other lifestyle changes. You expect to see somebody going from living in a big house to perhaps living in a smaller house or an apartment. You might see somebody going from driving a really fancy car to a more modest car, right? Because you live based on your income, right? So when you are talking about the IRS building a case against you, they're putting this stuff together to build a picture of what's going on. And unless you have the documentation and all of that to substantiate what's going on in your business and in your life, guess what? You are guilty until you prove yourself innocent. And if you can't prove yourself innocent, they won. And the IRS, listen, they don't bring a case unless they are pretty darn sure that they're right. Okay? So, so folks on social media posting all this stuff, don't let your social media betray you, because it will. If you sitting up there and you all, listen, you see the people on the yachts, they drinking, having a good time at the party, right? And so the IRS is saying, okay, so you own a boat? Did you rent the boat? How did you do either one of those when you're not reporting any income? Doesn't add up. And so then it doesn't stop at you. Okay, we're going to check out your relatives to see if you got everything in your mama name, right? So you look at, oh, your baby mama over here, you hadn't missed any child support payments, and oh, she's not working, but yet she's got this really nice wardrobe and this really nice car, and your kids, they look fabulous, glad you're taking care of them, but how? So you have to understand that, like, this is like this, all of these things are real. Like, this is not some conspiracy theory, because it has happened to people, right? So that's it, you guys. This is something that is, it's kind of a fun topic to really let you in on how, the IRS really works, so that and just to understand that you might get away with something for a minute, but that's not going to be always. You're out here and you're telling everybody all your business. There's somebody that's going to be ticked off with you and will just go and rat you out and get paid in the process. I'm cool, right? So that's it for today's episode of Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come here to get your questions answered about your home business taxes. All right, have a great day, and I'll see you all next time. Bye.